Hi, welcome back to this mini investment series where I build a financial spreadsheet that hopefully will enable you to understand the prospects of your investments or your overall finances better. If you haven't done so already, please go back and start with the first video where I start with a completely blank spreadsheet and build up to a fairly elaborate model that outlines potential scenarios for your finances. In this video, I'm going to be adding a small part to the spreadsheet that illustrate the potential cash needs you may have in retirement. This is important, obviously, for lots of reasons, but one of them is that by better understanding our future cash needs, we can understand quite well what money we need to have now or what money we need to put aside every year in order to reach that target, and also, frankly, the risk that we don't reach the target. I think there's a huge advantage of building these spreadsheets that you will hopefully understand very well how all the numbers fit together and be able to adapt them, both the inputs and the model itself, to your specific circumstances. My name is Lars Krøyer. I'm a former hedge fund manager who's written a couple books about finance, and I'm now doing these videos as a hobby. I'm not a financial planner, so do your own work or take your own advice before you do anything I say in this or any other video. But let's get back to the spreadsheet.
So here we are back at the original spreadsheet, and just like before, I'm going to start by adding making a copy of this sheet and move it to the end, just so it's easy to follow these. And let's say adding retirement. It really could be any kind of spending here, but just for now, let's call it retirement. And insert row, we're going to make this I'm sure I'm not going to add enough rows. Let's just copy them down. Let's say we do this to age 90. Oops. So that should be, oh, that's not going to be enough, is it? Recalculate. Nope. We need to insert a couple more. And there you go. So there you go. That's 90. And now let's do this, that instead of making the contribution, let's assume that we start spending the money here. So we do that simply by putting in let's say minus 10,000 for now, and then make that equal. Let's say we keep that constant every year, so we don't grow it. Also, we should make the minimum risk allocation let's just for now assume we make that 100% in retirement, which is probably pretty reasonable. And there you have it. So now we have very, very simplistically added retirement spending. You can obviously change the numbers. This somewhat morbidly assume that you no longer need money after the age of 90. You can obviously extend it. Let's start by going up here and make this savings at 84. And there you go. So that's row 84, not age 84. So this essentially is saying that if you have this kind of spending, oh, that was a very happy year. So if you have this kind of spending in this scenario, you would have 531,000. Let's go ahead and hide these cells. But what I want to do is also show you now what's important is how many cases, if you ran this 1,000 times, and again, maybe hide a few of these cells. Sorry to be such a stickler for formatting, but so here I've hidden a bunch of the cells. So if you see this, and let's say the scenario where you go below 0, how many times would you not have enough money? And in this case, it's 1.3% of the time. So 13 cases out of 1,000, you would not have enough money past your 90th birthday. Now, so is that a lot or a little? It really depends on your attitudes towards risk. In reality, most people should change these allocations before. It's not like you should have a 50-50 allocation one year and then change it all to the minimal risk assets in retirement. In reality, you should increase your low risk allocation as you grow closer and closer to retirement. You might even have a higher equity allocation at a very young age where you still have room for things to go wrong. In a later video, and I want to mention this because it's really important, in a later video I'm also going to add the volatility to these contributions. You see here, we're sort of blindly assuming that you can make these contributions with no risk to it. But in reality, life gets in the way, and some years you might be able to contribute more, and the other years you may not be able to contribute any at all, or you may even withdraw money. Now, a further thing that's very important to think about is that it's also possible that your annual contribution might depend on the world around you, and the world around you might be well illustrated with the equity return. So if you take this scenario, for example, right, so it's saying this year equities are assumed to be down 51%. Well, maybe it's not a terrible assumption to say that in the following year you would not have been able, and that's such a terrible state of the world that in the following year you would not be able to make your regular contributions. So how do we incorporate both the randomness part of it and the fact that your spending would be influenced by the broader economy? Similarly, we should probably incorporate that in this case it assumes that you can withdraw 10,000 a year, and there might also be volatility in terms of what you actually need. So that's important. And finally, I think it's also important to know that you could also get to a point where if things have gone really, really well for you and you're 90 years old, you may not actually be, let's say that you're one of these people with way in excess of $1 million in this case. You may not actually need to have it all in minimum risk assets, because you would probably not just be saving for yourself anymore. You'd be saving for your descendants, and that can start to influence things. So, but I wanted to show how simple it is to make this change. We can, oh, by the way, if you wanted to change the allocations in these models, you simply go in and change these numbers. We can start by unhiding this the row. So let's go in format row, unhide, and let's say we say, well, every year from here we want to make it this, but we want to add 1% in minimum risk asset. Don't forget, by the way, let's say you do that up to the final year. There you go. So now we recalculate, and you see how this would be one way of doing it, a very simplistic way, maybe not actually a terrible way, but a very simplistic way. But again, let's do that in a later video. Please do comment if there are specific scenarios you want me to show how I can incorporate this in the video. That's really helpful to me, actually, because I'm not, I'm very aware, very conscious of the fact that it's hard to generalize these models, but they really can be used for a lot of good stuff in quite an easy way. But anyhow, so here you've shown it. So I want to emphasize that it's important that you look at this when you rerun the model 1,000 times, and you get a sense for what happens if you fall short. How likely are you to fall short given these assumptions? How sensitive are you to the assumptions? Let me just show you as an example. Let's say, well, I can contribute 4,000 a year. Let's just say that's fixed, but I can't grow it. That's it. And these are real numbers. What you see is all of a sudden, if you can't grow it, your shortfall goes up to, in this case, just over 25%. So that's essentially saying, well, if you can't grow your contribution by the 3% we assumed earlier, you're going to fall short in retirement 3% of the case. Similarly, what if you say, well, I need 15,000, not 10,000 a year? Again, you're going to start falling short more. And let's say, well, I need 15,000, but I also can't grow, the contributions. You'd fall short in more than 50% of the cases. So it's really, really important to understand how all these numbers work, and then perhaps start to use them as a way to think about what would happen in your life if you fall short. Are you able to recover? Do you have other sources to see you through retirement? In the next video, I'm going to walk through a way where we can show how we build a data table, so we can, in one easy overview, get a sense for how do these numbers, the median return, the median outcome, the max and the minimum, and cases where you fall short, how do those vary depending on how much you put into equities and the minimal risk asset to start with, which is obviously a major assumption, and one where you'll see the outcomes will vary quite dramatically based on that assumption.
So thanks for watching. I hope this has been interesting or useful. Please leave some comments if there's anything else you want me to add to these videos. You can subscribe to my channel if you want to hear about future videos, or share this on social media. But in any case, I hope to see you in the next video.